Get a special voice today. We have Andrew Holland, the CEO at Avendus Capital Alternate Strategies, joining us on the show. Good morning, Andrew, and thank you so much for joining us. At this point in time, taking into consideration the way we're seeing global markets pan out, crude movements, also interest rate trajectories, not only in India but also in the US. What is the impact and what are the cues that you're looking out for when it comes to Indian equity markets?
So all those cues are, pretty negative actually, but global markets, including our own, are just ignoring them for the time being. So you really have to think that rather than try and second guess the market at the moment, let the market go where it needs to go. But a lot of these headwinds are still out there. The China trade is with the US is whether that's who's going to blink first, we have to wait and see. And I just saw some PMI data out from China, which is a bit below consensus. So, it's starting to hurt, and it's China's a big enough economy where you could see a fallout from that. So, at the moment they're using their currency to depreciate and try and take away some of the pain, but they're also throwing money at it as well. So that tells you that there's a bigger problem. And in fact, the indices in China is telling you that there is a problem. So. I'm not sure I'm kind of as gung-ho as the markets would expect me to be at this stage. And we've got some big events this week, obviously with the RBI and the Fed. And whilst both might be on hold, the trajectory for interest rates is higher, not just for those two countries or our country as well, but for the rest of the Europe and Japan as well.
Let's talk about the financial sector then, Andrew. What have you made of the earnings which have come through, and what are you expecting from the private sector banking names specifically? How are you dealing with them? What is your approach here?
So again, we like the private banks. The theme hasn't changed. Private banks are going to continue to take market share from the PSU banks. And as the economy continues to grow, they will continue to take market share. And it's been shown throughout. Even if you look at HDFC yesterday, it's showing that they're taking market share from somebody, and that's going to be the PSU bank. So, the good news is that as the economy grows, then usually there's a bit of crowding out and more competition. But I think the private banks are well placed now to continue this strong growth. Plus, we're probably coming for those private banks more towards the end of the kind of, bad loan, problems which have plagued the whole banking sector. So again, you're going to get a fillip in some of the earnings as well going forward, which we saw a little bit yesterday in Access, and you're going to saw in Bank of Baroda. So, this is a good news for the banking sector, but it's very selective. In terms of where you want to be. So private banks is where we're continuing at the moment. PSU banks, whilst they're going to have these sporadic rallies as markets are good, the fundamental still remains very poor. Even if you recapitalize them, they're way behind now in terms of market share. So it's going to take a long time and some great management to really turn around these banks. So we're going to keep clear of PSU banks for a lot longer at the moment.
Interesting. Andrew, good morning, Neeraj here. So just dwelling on that point a bit longer, for the last couple of months we've been hearing a few market participants saying that it's now time to start taking an exposure to the corporate facing banks. I know you mentioned that PSU banks are a no-no, but within the private sector banks as well, would the favors now tilt in the way of the corporate facing banks, or would you still believe that if you had large money to deploy, you would still prefer the retail focused banks?
I think a combination of the two. You're right that the corporate banks, the valuation differentials probably make it worth looking at a little bit harder. And in fact, that's what we've been doing as well, is spreading across the banking sector, retail and corporate. Because we feel that that's the where you're going to get the growth kicker, and valuations are reasonable enough to take that bet. So I think it's going to be a combination of private and corporate banks which are going to lead the banking sector going forward. This will probably drag up the PSU banking sector, but if and when markets fall, globally and locally, then the PSU banks would be the first to sell off, because there's no real fundamental reason to buy them apart from you're liking certain parts of the banking sector.
Andrew, the quality at any price argument seems to find favor not just with the HDFC Bank, HDFC AMC IPO, but Page Industries seeing some buying. Avenue Supermarts, the numbers are good and seeing some further buying. We've seen that happen to Bajaj Finance post their numbers as well. Are you on the same side, buy quality almost at any price, or are you now starting to tilt towards the other side?
So, whilst not voting on those individual stocks, let's just take the consumer sector. I mean, the kind of, Unilevers, Nestle's and so forth, would I continue to buy them? Yes, I would, because I think it's a long-term story which is playing out, and for the first time, you will see, or you've seen and will continue to see, top-line growth in double digits, which will lead to, very strong earnings going forward. So, would I want to continue to hold or buy these stocks? The answer is yes, because, the story over a 3 to 5 year period is just compelling. So whilst I might be paying for a high PE now, in 3 to 5 years, I'll look back and say, that was actually still a cheap price to buy because of the earnings growth. So there are certain sectors which we like, and we'll continue to buy that quality, because you've got to think about where the picture will look in 3 years' time, and what size of a company you might have at that point in time. So that's why the likes of the Bajaj Finances are still gaining a lot of investors, because they can see that in 3 to 5 years' time, it's going to be a lot larger company and a major financial sector player. So, whatever you're paying now is actually going to look a bargain in 3 to 5 years' time.
Interesting. What's also doing very well today, by the way, at the start, the first 13 minutes of trade, is Tech Mahindra. The stock is up in about 3.5%, and the numbers, do they justify that, Agam?
I would say so, Neeraj, because we need to remember that Tech Mahindra, in terms of the price performance, has not been as robust as some of the other IT companies. That said, when it comes to its earnings for this quarter specifically, well, the numbers were largely online. The positive surprise perhaps was the margins, where the contraction was less than anticipated. So we did see margins come in around 13%. And there are some positive cues with respect to turnaround in some of its subsidiaries, which were not doing very well last year, have started to, show some amount of results. Of course, they have had to reduce businesses on some of the loss-making aspects. The other issue, variable that everyone is keeping an eye on is that while its communications vertical, which is its largest vertical, has seen a decline in rupee terms on a sequential basis, there is a lot of impetus and perhaps some focus when it comes to the 5G capital expenditure in important markets for Tech Mahindra like Europe and the US. Of course, there are some concerns with respect to delay when it comes to spectrum allocation in these markets, but once capital expenditure comes into play for 5G in some of these key markets, we will likely see Tech Mahindra pick up in terms of earnings, and that is going to be a key focus area in for Tech Mahindra. So these are some of these factors which are likely trending the stock higher. So,
Andrew, you want to take a shot here? The IT space?
We still like the IT space. I mean, obviously, we have to be fairly selective, but we would continue with the large caps. I listened to what you said on Tech Mahindra. I mean, 5G is coming, so expect the stock to continue to be re-rated over the course of the year. So it's had its consolidation phase, or it's lagged the others. But again, this is a sector which we like for a number of reasons. One, the growth is back. It's not back to where it was in the in the early part of the 90s and 2000s, but it's back, and that's the good news. The other good news is that so a lot of the companies with cash are either buying back the shares or giving more dividends to shareholders. So that's the extra catalyst for the share price. But I think if and when things turn down and interest rates go up in the US, then I think the rupee is probably heading towards 70 quicker than we expect. and that again will be a good tailwind for the IT sector. I'm sure you're going to say, well, what about the pharma sector, because that should be a beneficiary as well. I just can't get over the line in terms of buying the stocks at the moment. Fundamentally, they're looking reasonably cheap, but unfortunately, the regulators keep coming and damaging the share prices, just when you feel it's a little bit safer to dip your toes. So again, I'm just going to, I think it's another quarter away before I get more constructive on the pharma sector. The new sector which we're liking or getting a little bit more constructive on is obviously regarding the capex cycle, and the likes of L&T and ABB, showed us, the kind of results and execution which is starting to happen. So I think it's not going to be, a kind of a runaway sector, but I think it's probably through its worst, and now we'll start to see both execution margins and order books starting to rise as the capex cycle slowly starts to pick up in certain sectors. So we're starting to like the kind of capex players.
Andrew, we all know that the Nifty and the Sensex is at lifetime highs at this point in time, which means that some of these large cap names continue to trend higher. My question then is, would it be fair to say that these markets and these names are ripe for some correction, time correction perhaps, if not a price correction at this point in time?
Listen, I think the whole market's ready for a correction. I've been thinking like this, or more conservatively, cautiously about not just the Indian index, but globally. But markets do what they have to do, and sometimes you sit around thinking, well, what am I missing? But fundamentally, there's a lot of negatives out there, which I still feel will need to be priced in at some point. And you can't lose, I don't know how much it is in tech stocks, 300 billion or more. Without having some effect on shareholder wealth. So at some point it will come home to roost, but I'm not sure when that will be, but I think it's sooner rather than later. And therefore, obviously, all stocks will fall. But, the interesting thing is that despite, what we're seeing, you're seeing a couple of sectors where pricing pressures, starting to eat in, even though it's been a sector which should be doing very well or has been doing very well. So if you take the two-wheeler sector, you've got Bajaj there being disruptive in terms of what they're doing, and then if I look at the airline sector, I mean, the leader is telling me, I can't even make money in this sector when you're seeing huge amounts of growth. So, there's a lot of areas which are kind of quite worrisome, which if markets were to fall, you see a sizable fall in some of those stocks. So that's what you've got to watch out for. Is some of the bad news is being masked by just our enthusiasm for new index highs, but it's being led by a very small number of stocks, and it's very rotational. So it makes you feel that unless you're in that stock for one day and you make money, then you've got to find another stock for the next. And I think that's where once the music stops, then it depends on which chair you're sitting on.
Fair enough. Well, of course, that's a very valid point out there, Andrew, but we'll leave it at that. Thank you so much for joining us and taking us through your views on the Indian equity markets.
Pleasure.